is Strategy Inc., formerly MicroStrategy, a company run by a generational visionary who has just cornered the ultimate high beta play on the coming Bitcoin supercycle?
Point.
Or are we looking at a critically illiquid, cash-burning enterprise whose aggressive strategy has placed it right on the razor's edge, setting it up for a catastrophic, high-stakes death spiral?
It is perhaps the most complicated, controversial, and polarizing financial entity on the public markets today. I mean, you have a combination of deeply entrenched legacy tech and, well, cutting-edge yet extremely high-risk financial engineering.
And you just can't use the normal playbook to analyze it.
You absolutely cannot. You simply cannot analyze this stock using any traditional valuation metric. It just doesn't work.
Okay, let's unpack this. Welcome to the deep dive. Today we are plunging headfirst into Strategy Inc., trading on the NASDAQ under the ticker MSTR. We've gathered extensive research, and our mission today is to really extract the essential insights you need to understand this dual identity company.
And to separate the genuine operational reality from the powerful but, let's just say, fragile Bitcoin fiction.
Exactly. And we are anchoring all of our analysis to the date of November 18th, 2025. It's a moment of severe market stress for the company, trading at a prior close price of $195.42 per share.
A very critical moment in time for this stock.
And let's not bury the lead here. The research points to a conclusion that really flies in the face of what many believers might assume. Our intrinsic valuation analysis suggests that the stock is currently trading at a very significant premium.
A huge premium.
Specifically, a 22.5% premium over the verifiable net value of its assets. This massive speculative bet exists despite the company facing a complete technical collapse and exhibiting critical, fundamental financial risks that we are about to expose.
It means the market is pricing in a perfection scenario, which, I mean, it just seems totally counterintuitive given the reality of the balance sheet we're looking at.
Yeah. We need to understand exactly how that premium is being justified and what the true risk profile really is. Part 1. Chapters 1 to 3. Business, Management, and Financials. Chapter 1, Business Understanding.
To start, you really have to acknowledge the duality. You have to. The company legally embraced its split identity, which is why, back in February 2025, they changed the corporate name from MicroStrategy to Strategy Inc.
And that wasn't just a PR thing?
No, not at all. There wasn't a minor PR move. It was a deliberate legal signal that they function as two distinct, almost entirely separate entities under one single roof.
We're calling this the tale of two companies. So on one side, you have the legacy operation, the enterprise software business.
The original company.
Right. The original 1989 B2B operation selling classic enterprise business intelligence, or BI, mobile software analytics tools. They still generate revenue the old-fashioned way, software licenses, cloud subscriptions, and consulting services.
They even recently launched Strategy Mosaic, which is a new AI layer for their flagship Strategy One platform. So they're still investing, at least a little.
A little, yeah. But that legacy business is, frankly, the tail being wagged by a very, very big dog.
It absolutely is. The dominant and defining entity is the Bitcoin Treasury business, which they adopted aggressively starting back in 2020. This business has one, and really only one, explicit function: to act as a capital-raising vehicle.
So its job is just to get money.
Its entire purpose is to issue high-yield debt, issue massive amounts of new stock through these ATM programs, and then use all of those billions to strategically accumulate Bitcoin. That's it. That's the business.
And the success of that accumulation strategy is, you can't deny it. It's undeniable. The primary asset that defines the stock price, the company's entire valuation, is that staggering Bitcoin stack.
Following a series of highly leveraged purchases as of our analysis date in November 2025, Strategy Inc. holds 649,870 BTC.
Wow. Just say that number again.
649,870. It's a figure that's almost impossible to grasp in context.
It really is.
Strategy Inc. is the undisputed largest corporate holder of Bitcoin in the world. We're talking about an accumulation that is more than 10 times larger than the next corporate holder. They set the standard for what a corporate treasury can do, and that scale, that is a core pillar of the bullish argument.
So when we look at their official messaging, operational excellence and strategic Bitcoin reserve, it sounds so conservative. But you mentioned the real value proposition for the investor is something else entirely.
Right, that's the corporate line. The real value proposition, and this is the absolute key insight you need to understand, is that MSTR is a leveraged Bitcoin proxy.
A leveraged proxy. So you're not just buying Bitcoin, you're buying a turbocharged version of it.
Exactly. Because they use aggressive debt and equity issuance to fund those nearly 650,000 coins, the volatility in MSTR stock is amplified relative to the underlying asset. Our sources confirm this has been consistent. Historically, a 1% move in BTC often translates to a move of more than 1%, sometimes significantly more, in MSTR stock. It is the high-octane version of owning Bitcoin.
So an investor is essentially paying a premium for the ability to leverage their exposure without having to, say, take out a personal margin loan.
That's the idea. But this leverage strategy forces the company into what our sources are calling a war on two fronts when it comes to competition.
Okay, let's break that down. The first front is the software.
Precisely. On the software front, they're a legacy player in a very tough neighborhood. They compete directly with giants like Microsoft's Power BI, Salesforce's Tableau, Oracle, IBM. I mean, the biggest of the big.
And as we'll see in the financials chapter, the data confirms they are losing this war. Revenue is stagnant or even declining. They're just not the competitive leader in software anymore.
Not even close. But the existential competition, the real war, is on the other front, the Bitcoin proxy battle.
So who are they fighting for investor capital now?
Well, now they're competing with spot Bitcoin ETFs, like BlackRock's Yottabyte, major crypto exchanges like Coinbase, and the highly leveraged miners like MSTR and Riot.
And the approval of those spot Bitcoin ETFs. That was a game changer.
It was a watershed moment. It represents the single greatest competitive threat to Strategy Inc.'s original investment thesis, period.
Why is the ETF threat so devastating for them?
Because the ETFs offer direct, safe, low-fee BTC exposure with none of Strategy Inc.'s corporate baggage. I mean, think about it. If you buy an ETF, you avoid the $14 billion in corporate debt, you avoid the litigation risks, the controversial management.
And the drag of the failing software business.
Exactly. For large institutions, especially those that are really sensitive to their fiduciary duty, the ETF route is a vastly superior, cleaner, and frankly safer method of exposure.
This leads us to this critical concept of the moat, or their historical competitive advantage. Strategy Inc. historically relied entirely on its massive premium to net asset value, or NAV. Can you walk us through how that funding magic trick worked?
Yes, this is so important. The NAV is simple to understand. It's the market value of their Bitcoin, plus whatever you think the software business is worth, minus all their fixed claims. So all their debt and preferred stock.
Okay, assets minus liabilities.
Right, and for years, the market cap of MSTR was consistently 2 times, sometimes even as high as 2.7 times, higher than that calculated NAV. This premium was their entire business model.
So if the stock traded at a 2x premium, for every $1 of verifiable net assets on the books, the market assigned $2 of value to the stock.
Exactly. And this allowed Saylor to execute what we call the accretive strategy. They could issue $2 worth of new stock via their ATM program. They'd sell that stock, take the cash, and use it to buy $1 worth of Bitcoin.
I see. So they are creating value out of thin air.
It seems that way. Since they issued $2 of value to buy $1 of net assets, that transaction was accretive. It actually grew the amount of Bitcoin per share for existing holders. The premium was their funding machine, their moat, their competitive edge.
That's a fascinating, almost paradoxical mechanism. But you mentioned a critical finding in late 2025. That premium is gone.
It has dramatically collapsed. The sources show it plummeted from its high of 2.7x all the way down to approximately 1.19x as of November 2025.
Wow.
And some data points even show it temporarily dipping below 1. This collapse, which is driven largely by the availability of those low-fee ETFs, breaches the moat. It shatters it.
So if the market cap is only 1.19 times the NAV, or worse, below 1, what does that mean for their funding machine?
It means issuing new stock is no longer accretive. It becomes dilutive.
Meaning it hurts existing shareholders.
It actively harms existing shareholders just to raise cash to buy more Bitcoin. If that premium to NAV vanishes entirely, the whole growth model, the BTC yield strategy, it just shuts down. The unique funding mechanism they relied on for years, the one that justified all the leverage, is now fundamentally broken because of competition.
That is an enormous shift in the investment thesis, which means we really need to understand the individual who is guiding this high-stakes shift. Chapter 2, Management Evaluation.
As we move into management, we have to recognize that Strategy Inc. is almost singularly defined by one person, Michael J. Saylor. This is the absolute definition of key man risk.
Right. even though Fong Li took the CEO role in 2022 to handle the stagnant software operations.
Sailor-Roy's the executive chairman, and he's focusing 100% of his energy on the Bitcoin strategy and capital allocation. The software side is not his priority.
To his followers, he's a figure of immense foresight and genius, a visionary. But for traditional value investors, the sources highlight a history that would immediately raise some very severe governance and integrity red flags.
You absolutely must account for his track record, particularly the two major historical crises involving financial misconduct. The first one was way back during the dot-com bust in 2000.
The SEC charges.
Yes, the company faced charges from the SEC for fraudulently reporting financial results for 2 consecutive years.
That is incredibly serious. What was the fallout for Saylor personally?
Saylor personally settled the charges, which is a major red flag for any financial executive. He paid a $350,000 civil penalty and, significantly, $8.3 million in disgorgement of ill-gotten gains.
So he had to give back money he made.
He did. And when a founder is involved in a financial restatement that leads to SEC charges, it fundamentally and permanently damages institutional trust.
And unfortunately, the pattern of trouble did not stop there. The sources confirmed the 2024 tax fraud suit.
Correct. More recently, in 2024, Saylor paid a staggering $40 million fine to settle a tax fraud suit brought by the District of Columbia.
$40 million.
$40 million. It was related to claims he avoided paying income taxes by pretending to live elsewhere. I mean, think about the scale of that. A $40 million personal fine.
That's incredible.
For many traditional investors, those two incidents, the SEC charges and this massive tax fraud settlement, they're immediate deal breakers. It doesn't matter how well Bitcoin does. They signal a persistent willingness to operate outside of normal compliance norms.
And the management team is still battling active litigation even now, right? Specifically a shareholder derivative suit from June of 2025.
Yes, and this suit is directly focused on the Bitcoin strategy itself. It alleges that management made false or misleading disclosures regarding the fundamental risks and extreme leverage associated with the BTC acquisition strategy. This constant cloud of governance risk is why the stock trades with such a significant risk premium baked into its volatility.
Now let's look at the financial philosophy here. The sources make it crystal clear that this company is the absolute antithesis of a traditional value company and how it allocates capital.
Oh, completely. Traditional value companies, they reinvest in high ROI operations, they pay dividends, they buy back stock when it's cheap. Strategy Inc. does the exact opposite of all of those things.
The strategy is explicit.
It's completely explicit. All available capital is earmarked for Bitcoin. That's it. Investments in the software core, like that Strategy Mosaic AI layer, they are secondary and, frankly, minimal.
And their treatment of common shareholders is, well, it's aggressively dilutive.
They have never, not once, paid a common stock dividend. They actively sell new shares through their APM program, constantly flooding the market with new equity, which directly dilutes the ownership stake of existing common shareholders.
All to fund more Bitcoin purchases.
Exactly. The common shareholder's primary function is to serve as an ATM for the acquisition strategy. That's the role you play.
But they do prioritize certain payments, namely those related to their preferred stock, which are liabilities.
Yes, and these are very expensive liabilities. The preferred stock instruments rank higher than common equity, so they have to get paid first. We see this commitment in the recently raised coupon on their STRC preferred stock,
Which now requires them to pay what?
an enormous 10.5% dividend rate. That cash payment is fixed. It must be paid. And it consumes scarce liquidity that the company desperately needs.
This brings us to the core intellectual justification for this entire pivot, which the sources term the Rosetta Stone, the ROIC versus WACC calculation. I think we need to explain this thoroughly for the listener.
This calculation is absolutely vital because it explains why Saylor's pivot, despite the extreme risk, was rational from a purely economic standpoint, at least regarding the existing software business.
Okay, so WACC is the weighted average cost of capital, the cost to fund the company.
Right. It's the minimum return a company needs to generate on an investment to satisfy its debt and equity holders. And ROIC is the return on invested capital, the actual return they get.
So if your WACC is, say, 15%, and you only generate a 5% ROIC, you are actively destroying shareholder value with every dollar you reinvest.
You're burning money. Exactly. Now let's apply that to the 1989 software core. Its ROIC is abysmal. Our sources report it as negative, fluctuating between negative 0.07% and negative 2.45%.
So it's losing money on the capital it invests.
The core business is not generating a return on the capital invested in it. It is actively destroying it.
And at the same time, because they rely so heavily on high-risk, non-investment grade or junk debt, and those expensive preferred stock dividends, their WACC, their cost of funding, is sky high.
It's massive. Their blended WACC sits in the terrifying range of 18.25% to 23.55%. This is a prohibitively expensive cost of capital.
So the conclusion is just inescapable. ROIC is dramatically less than WACC.
This is the fundamental existential justification for everything. Every single dollar the management reinvested in the stagnant software business was demonstrably destroying shareholder value. So Saylor looked at that reality and determined that the only way to generate a return greater than his 20+% WACC was to use the corporate vehicle to acquire an asset, Bitcoin, that he believed would appreciate faster than his immense cost of capital.
So it was a trade-off.
It was a trade-off. Abandon the guaranteed value destruction in the core business for high-risk, high-return speculation in the financial markets.
It's a rational strategy for a dying company, but it trades operational risk for extreme balance sheet fragility. It's essentially a last-ditch existential bet.
A high-stakes gamble built on billions and billions of dollars in fixed obligations.
Now that we understand the business, the motivation, and this unique funding model, let's dive into the cold, hard numbers and expose the illusions in the financial statements. Chapter 3. Financial health. The company carries a substantial market cap, sitting at $56.16 billion. But let's start with that operational engine, the software core.
The software business is the primary weakness. Its revenue trend confirms a decline. The 5-year average revenue growth is negative 1%.
Negative growth.
Negative. And if you look at the trailing 12 months, or TTM revenue, it's a flatlining and slipping. It's moved from nearly $500 million a few years ago down to $475 million TTM. We must emphasize this for you. This is not a growth company. The core engine is sputtering.
But this is where the financial statements become, well, actively deceptive. We see reports of this massive consolidated net income, which is just wildly misleading.
This is what we call the profit illusion. And it is absolutely crucial to understand this accounting maneuver. Now, the software business itself actually generates a healthy gross margin of 70.5%. But when you look at the consolidated numbers, you see a net income reported at a colossal $2.8 billion.
A company with $475 million in TTM revenue cannot possibly generate $2.8 billion in operational income. So how is this figure legally produced?
It's due to the adoption of a new fair value accounting rule, ASU 2023-08. Before this rule, Strategy Inc. had to report Bitcoin as an intangible asset and could only realize losses or impairments. Now, the new rule requires them to mark their massive Bitcoin holdings to market value.
And report the changes on the income statement.
Yes, they have to report the resulting changes, the paper gains on the income statement each and every quarter.
So that $2.8 billion net income is entirely the non-cash, unrealized appreciation of the Bitcoin stack. It's a paper profit, not operational cash.
Precisely. It is an accounting fiction that significantly distorts all the traditional metrics. This is why the price-to-earnings, or PE ratio, is statistically useless here. The PE ratio of 7.78, which looks cheap on the surface, is an illusion.
Because the earnings, aren't real earnings.
It's not true cash flow. So any serious analyst has to strip this number out and look at core earnings, which are minimal, or in this case, negative.
Since net income is unreliable, we have to turn to free cash flow, FCF, to assess operational viability. And here we find the cash flow crisis.
The FCF trend shows a sharp decline right into negativity. It has collapsed from a positive position to negative $67 million in 2024. And the Q3 2025 filing confirms the dire situation. They had cash used in operations of $45.6 million.
The core business is actively burning cash.
It is burning cash. So if the operations are burning cash, where did the money for the $19 billion worth of Bitcoin purchases over the past year actually come from?
External financing.
100% reliant on external financing. The Q3 filing confirmed that the only source of cash was $19.47 billion raised through issuing new stock and new debt. Strategy Inc. is not a sustainable operational entity. It's a financial vehicle that requires new investor capital perpetually just to survive and continue its strategy.
If that faucet of new money shuts off,
they have a massive, massive problem.
And that brings us to the two most glaring red flags on the balance sheet. liquidity and leverage. Let's start with liquidity and the current ratio.
This is perhaps the single most critical, fundamental warning sign. The current ratio, which measures your short-term assets against your short-term liabilities, is 0.66.
And safe is 1.0 or higher.
Well above 1.0. A ratio below 1 means the company fundamentally does not have enough liquid assets, cash, receivables, to cover all its bills that are due in the next 12 months. This is a severe, imminent liquidity risk.
And the physical cash on hand just confirms this illiquidity.
It is an almost unbelievable vulnerability for a company with a $56 billion market cap and billions in fixed obligations. Strategy Inc. has only $54.3 million in cash.
54 million. That's a rounding error for a company this size.
It's minuscule. This lack of a cash buffer is the core reason for the death spiral warning. If they cannot access the capital markets, they have no ability to pay their high-interest debt and expensive preferred stock dividends without selling Bitcoin.
Let's look at the debt illusion next. If an investor just glances at the debt-to-equity or DE ratio of 0.14, it looks perfectly safe.
Oh, it looks great. But that ratio is wildly deceptive because of the asset mix. That $58.12 billion listed as equity is nearly 100% the mark-to-market value of volatile Bitcoin.
So if Bitcoin drops by 50%,
that equity just vanishes.
Yeah.
However, the $8.174 billion in long-term debt is fixed. It must be paid back, regardless of the BTC price. This is extreme leverage risk hidden behind an accounting number that is extremely volatile.
Given all these accounting distortions and the negative operational cash flow, traditional discounted cash flow models are, well, they're useless here.
Totally inappropriate. The only reliable methodology is the sum of the parts, or SOTP analysis.
SOTP is the mandated approach. We have to break the company into its constituent parts, value the Bitcoin, value the software, and then subtract the fixed claims. Let's run the full calculation based on the November 18th, 2025 data.
Okay, let's do it.
We start with the primary asset, the Bitcoin holdings. That's 649,870 BTC at a price of $90,500 per coin.
That gives us a verifiable asset value for the Bitcoin stack of $58.81 billion. This is the foundation.
Okay. Next, the software business. Since it's cash negative and declining, a fair valuation is pretty difficult.
It is, so we have to be generous to the bulls here. We use a very generous valuation of 2 times TTM revenue of $475 million. This gives the software business a value of $0.95 billion, or $950 million.
And even at that generous multiple, the software value is less than 2% of the total enterprise value.
It's a rounding error. So our total asset value is approximately $59.76 billion.
Okay. Now for the liabilities, the fixed claims that rank ahead of us common shareholders.
We have 2 major categories of claims. First, the total long-term debt of $8.17 billion. Second, we must account for the preferred stock claims, which function essentially as mezzanine debt with higher seniority than common stock. That's another $5.79 billion.
Which means the total fixed claims against the assets that must be subtracted are $13.91 billion.
That's the number. And subtracting those claims from the total assets gives us the intrinsic equity value, or the net asset value, the NAV, of $45.85 billion. This is the objective, verifiable value based on current prices.
That concludes our look at the fundamentals. The liquidity is critical, the core business is failing, and the valuation methodology reveals a quantifiable value that is significantly lower than the market price. Like and subscribe to Stock Analytics AI.
If you appreciate this level of detailed, fact-based financial exploration, we really do encourage you to join our membership.
For $4.99 a month, get 500-plus deep dive videos on all S&P 500 stocks, with NASDAQ 100 coming next, plus members-only requested deep dives. We've established the foundation. Now we pivot to the environment, how the market views this gamble, who is buying and selling, and the mechanisms that could lead to complete failure. Part 2, Chapters 4 to 7, Market Sentiment, Ownership, Risk, and Final Conclusion. Chapter 4, Market Sentiment.
Market sentiment around Strategy Inc. is a textbook case of contradictory signals. We have this massive disconnect between the sell-side analysts and the actual price movement of the stock.
Analyst consensus is strong buy, with price targets reaching up to $532 per share, which implies a potential triple from the current $195 level.
But here is the challenge, and it's a big one. These ratings are almost entirely decoupled from MSTR's corporate fundamentals. These analysts are not buying Strategy Inc. because of its software or its cash flow.
They're buying it for the Bitcoin.
They are issuing buy ratings based on their hyper-bullish forecasts for the underlying asset, Bitcoin. They're projecting BTC to hit $300,000 or more, and Strategy Inc. is simply their preferred leverage vehicle for that move. It's a reflection of BTC conviction, not MSTR conviction.
And meanwhile, the media and the technical charts are just screaming the opposite
Oh,
message.
completely. The general media narrative is overwhelmingly fearful and negative. Headlines highlight the collapse. Strategy stock falls to 7-month low, and the steep decline of down 40% in the past 6 months. The controversy surrounding Saylor and the debt strategy means the narrative is dominated by critics.
Which forces Saylor to respond.
It forces him to publicly address and dismiss rumors that the company is secretly selling its Bitcoin stack to handle its mounting liabilities. I mean, that kind of environment just breeds intense bearish pressure.
Let's analyze the technical picture. We often look at short interest, the number of bets against the stock, as a measure of bearishness. And short interest is actually decreasing from its peak. That sounds positive, doesn't it?
It would be positive if the stock were rising, but the stock is plunging 40%. The short interest decreasing from 29.1 million shares down to 25.28 million shares. That signals that the shorts, who were most aggressive, are already covering their positions and taking profits.
So the selling isn't coming from the shorts anymore.
Exactly. This means the sustained, massive selling pressure is now coming from a much more concerning source. Long-term holders and institutions capitulating. They're running for the exits, losing conviction in the long-term viability of this leveraged strategy.
And the technical collapse is visually stark. The stock is trading at a 52-week low.
If we look at the moving averages, the long-term uptrend is completely and utterly broken. The current price of $195 is dramatically below the 50-day moving average at $295 and the critical 200-day moving average at $339.
And that's a classic bearish signal.
When a stock trades this far below its long-term average, it confirms strong, persistent bearish momentum. Technicians view this as a clear, strong sell signal, regardless of what Bitcoin itself is doing.
It's fascinating how the technical indicators and the analyst reports can be so completely opposed. It just reflects that inherent conflict between speculation and fundamentals. Chapter 5, Ownership Structure.
The ownership profile of Strategy Inc. really confirms its identity as a speculator's playground. It operates more like a derivative vehicle than a traditional public company.
We see that ownership is dominated by derivatives.
Yes, and the numbers are just remarkable, according to the Q3 2025 filings. There are more shares held via call options, that's 72 million, and PUT options, 72.5 million, than are held in actual common stock, which is only 47.2 million.
Wait, so there are more options than actual shares held?
Think about that scale. Nearly twice as many shares are controlled by short-term, high-risk derivative contracts than by actual equity holders. This just confirms the environment is volatile, high stakes, and driven by short-term derivative traders seeking leveraged exposure.
We did see some passive funds like Vanguard and BlackRock adding positions. Does that signal some kind of fundamental belief in the company?
It is highly unlikely. The analysis suggests that these passive funds were primarily front-running a potential S&P 500 inclusion.
Ah, the S&P 500 bet.
Right, this is a massive speculative bet among institutional traders. If MSTR were included in the S&P 500, it would trigger a mandatory, non-fundamental forced buying event by index tracking capital, possibly in the trillions of dollars. Passive funds were positioning for that catalyst, not for the software growth.
But the truly worrying signal comes from the smart money that has already exited.
Yes, the exit of Paul Singer's respected activist fund, Elliott Management, in Q3 2025 is a very strong bearish signal. Elliott Management is known for deep analytical dives and high conviction positions.
They do their homework.
They do. And their decision to exit their entire stake suggests they see far more risk than reward at current valuations. It's a powerful vote of no confidence.
And finally, let's look at the behavior of the people who know the company best. The insiders. We know Michael Saylor maintains outsized voting control, around 45%, meaning public shareholders have zero ability to alter this high-risk strategy.
And the optics of the insider transaction data are just terrible. The entire C-suite, CEO Feng Le, CFO Andrew Kang, and General Counsel Weiming Xiao are all registered net sellers.
They're selling stock.
They've been liquidating their own shares during this 40% stock collapse. When the executives running this strategy are quietly selling their own equity into weakness, It completely undermines the key man's bullish rhetoric and signals a very low confidence in a short-term recovery.
The stage is set. A high-leverage vehicle run by a controversial figure, facing institutional exits and battling severe illiquidity. This brings us to the core analysis of what could go fundamentally wrong. Chapter 6, Risk Assessment.
We must systematically map the risks using the SWOT framework. Let's start with the few elements of strength that the bulls really rely on.
Okay, the strengths, the S. These are undeniable. S1, the unmatched BTC scale. That 649,000 stack is real, and it is massive.
S2, the first mover brand and iconic status, which is tied directly to Saylor's very public advocacy. And S3, this is crucial, their proven capital access. They have a track record of successfully raising billions, even with junk debt and dilution, which is vital for their survival.
But the weaknesses, the W, are fundamental and potentially fatal flaws.
Yes, W1, extreme leverage. That's the $13.9 billion in fixed claims.
Yeah.
W2, negative core cash flow. They are burning operational cash.
Yeah.
W3, the most dangerous, critical illiquidity. That 0.66 current ratio and only $54.3 million in cash means they're perpetually vulnerable to a funding shock.
And then W4, the constant shareholder dilution, and W5, the underlying value-destroying software business where ROIC is less than WACC. Now, let's focus on the threats, the T, which are the actual mechanisms of collapse. The immediate threat is T1, a Bitcoin price collapse. If BTC drops severely, it rapidly evaporates their equity buffer, risking debt covenant breaches on that $8.17 billion in debt.
But the most complex and dangerous threat is T2, the so-called capital market closure or the death spiral. This is a liquidity crisis, not just a price crisis. Remember, the company's entire business model requires the perpetual ability to raise new debt and issue new stock just to pay their liabilities and fund their purchases.
So what happens if that capital market closes to MSTR?
If high interest rates persist, or if investor fear deepens due to bad news or litigation, the market's just close to them. Strategy Inc., with only $54 million in cash and negative FCF, cannot service its expensive 10.5% preferred stock dividends or its debt obligations.
So what can they do?
The only way to generate the required liquidity is for the company to be forced to sell its BTC stack.
And that forced selling scenario is just catastrophic.
It creates a systemic, self-reinforcing crash. The forced selling by the largest corporate holder of Bitcoin would inevitably drive the price of BTC down. That lower BTC price further increases the strain on Strategy Inc.'s balance sheet, which spooks the remaining investors and closes the capital markets even more tightly. This accelerates the need for further selling, completing the spiral. That is the T2 death spiral.
It's a liquidity trap enabled by high leverage and basically zero operational cash buffer.
A perfect storm. Other threats, of course, include T3, the constant competition from safer, lower-fee ETFs, and T4, key man and regulatory risks such as potential new anti-money laundering or AML rules, or even politically motivated taxes on unrealized capital gains.
We must also look at the macroeconomic environment, particularly interest rates.
Yes, inflation is ironically positive for the core thesis, as it drives demand for hard, finite assets like Bitcoin.
But high interest rates act as a poison, correct?
They are the single biggest threat that can trigger that death spiral mechanism. Strategy Inc.'s $8.17 billion in debt is non-investment grade. It's junk. If the high interest rate environment persists, making refinancing that enormous debt load prohibitively expensive or even impossible, it vastly increases the chance of the capital market closure and the subsequent liquidity crisis.
The high-risk strategy only works in a low-cost-of-capital environment.
That's right. The entire enterprise is a delicate balance, reliant not on software sales, but on perpetually available cheap credit.
Chapter 7, Conclusion.
Let's synthesize these dramatic findings by revisiting the two opposing arguments that really define this stock.
Okay, the bull case summary is entirely forward-looking. MSTR is the mandatory high-beta leverage vehicle for the coming Bitcoin supercycle. Bulls accept the extreme governance and liquidity risks because they are betting that the BTC yield strategy.
The strategy of constantly growing the BTC per share through relentless capital markets access
will significantly outperform a simple, unleveraged buy-and-hold ETF. They are betting on Saylor's ability to just keep the machine running no matter what.
And the bear case summary is focused on the present reality. MSTR is a critically illiquid cash-burning company with negative revenue growth, led by a controversial key man with a history of financial misconduct. The $13.9+ billion in fixed debt and preferred stock obligations make the entire enterprise hyper-fragile.
They're reliant on constant external financing just to pay the interest on their existing financing.
It's a feedback loop. A sustained tightening of credit markets or a significant drop in BTC almost guarantees a catastrophic failure via that death spiral mechanism.
We have to conclude with the valuation, confirming why the stock's current price of $195 is such a speculative bet. We established that the sum of the parts model is the only tool that works here.
Correct. We calculated the intrinsic value, the net asset value, by totaling the verifiable assets, $58.81 billion in BTC, plus the generous $950 million for the software, and then subtracting the fixed liabilities of $13.91 billion.
Which leaves us with the verifiable intrinsic equity value of $45.85 billion.
And when you compare that NAV to the current market cap of $56.16 billion, you see the massive gap. MSTR is currently trading at a premium of $10.31 billion.
Which is a 22.5% premium over the net verifiable value of its asset.
Exactly.
So the market is currently assigning a massive quantifiable $10.3 billion of purely speculative value. It's paying for Saylor's vision, for the leverage, or for potential future catalysts like that S&P 500 inclusion.
Factually, the stock carries this large premium despite facing a complete technical collapse, trading at a 52-week low and displaying extreme fundamental risks, including the 0.66 current ratio and negative operational cash flow. This is a high-stakes conviction bet that is completely detached from any underlying operational sustainability.
So here's where it gets really interesting, and this is the ultimate question this deep dive leaves you with. The company's future isn't about whether the software succeeds or fails. It's a simple binary outcome tied to its fixed obligations. Is Strategy Inc.'s unique, proven ability to perpetually access capital markets, even at a high cost, sufficient to keep the death spiral at bay long enough for Bitcoin to reach the price required to make that $13.9 billion in fixed leverage entirely irrelevant? So that is the question that defines whether this stock is a visionary investment or a liquidity trap.
A fascinating, if terrifying, high-stakes game. And the volatility we see just reflects the binary nature of that very bet.
Like and subscribe to Stock Analytics AI.
To continue these deep dives into the most complex names on the market, become a member.
For $4.99 a month, get 500+ deep dive videos on all S&P 500 stocks, with NASDAQ 100 coming next, plus members-only requested deep dives. This analysis was generated by an AI system for educational purposes and should not be considered financial advice. Please conduct your own research or consult with a qualified financial advisor before making any investment decisions.